10-year note yields holding at the May to July midpoint. Recall we've had yields low roughly 195 to 215. We're hovering right at around 205. The market sort of has been sitting at this level, sort of waiting for some catalyst event and wonder what that could be. Well, we have July FOMC this week. I think it's been the big event on everyone's calendar, with the idea that not only is there going to be a rate cut, the first we've seen in a long time, but also with the outlook and how the Fed's going to handle the next several months. Are they going to be more aggressive at cutting rates, or are this just going to be a one and done type of move, or are they going to wait and see, use that patience moniker that we've become so used to with the Fed? So right now, 10-year note yields, after seeing that big move lower, have kind of inched up higher and have just been sitting right at the midpoint of that range from May to July, with the idea that maybe this is the day, this is the catalyst event that could break us out. Will we see yields break out above 215, head towards 2.25, or do we see yields go head south below 195, likely on their way to 185, which, if you recall, is the level we were trading back in November of 2016 when this all started. So at this point right now, though, we're not seeing any sort of indication from the market. It is going to wait and see. It's going to be more reactionary, I think, at this point than anything else. And if you look at market volatility, we would anticipate historically the volatility would be higher ahead of a key event like this, with the idea that there's a lot of uncertainty. But no, we're not seeing that. 10-year note implied volatility holding maybe a tad lower today, but nothing surprisingly. It's holding right at the 14-day moving average, not looking at any kind of big move. At least the market doesn't see a move outside of that range, outside of that 195 to 215 range, which is a very wide range to begin with. But given the size of the event that we have this week, breaking out of that range is something that I think some are pricing, but certainly not being reflected in market volatility. And lastly, let's look at what kind of effect could FOMC have on the bond market. Right now, we're seeing, expected a 25 basis point cut. That's really not going to have any much of effect. The forward outlook coming from the press conference, we're not going to get that from the Fed itself. We're going to get that only from Chairman Powell. It certainly could give us a knee-jerk reaction one way or the other, if they're going to be patient, if they're going to be data-driven, if they're going to have a mention on inflation. One thing that's been overlooked, I think, here is the balance sheet, something that will maintain its unwind as we head into September. So that's not going to change at this meeting, but certainly if he does mention that they may back off some of their unwind, or maybe will add more aggressively to it, that would have a big effect on the bond markets. Right now, that might be the only thing that could be a sort of a wrench in expectations that aren't being priced in, because right now the market is looking for a rate cut in July, another in September, and then a third in December. So the Fed, if they want to reel in some of that and maybe pull it back a little bit, they do have a tall task ahead of them, as the market has been clearly priced for 3 rate cuts. And right now the Fed looking for rate cut number 1 in 2019, but will they have more, and will they be more aggressive in the days and weeks ahead? We'll find out Wednesday.